Shares of Carvana are getting a boost today after an upgrade over at Wedbush, and this is our call of the day. The analyst who made the call, Seth Basham, is here with us now. Seth, good to see you this morning here. Thanks for hopping on. Look, I mean, Carvana shares, they're down about 12% over the past month. What has caused that selling, and why do you think it might be over?
Yeah, thanks for having me. I think the stock has underperformed recently with concerns around the unit sales outlook for the company and for the industry as a whole, for that matter. We've seen volatility in unit sales based on industry-wide data from Cox Automotive, and we think that Carvana is part of that issue. That is due to demand volatility, but also production problems. What Carvana and others do in the used car industry is they buy cars from consumers or wholesale auctions, they recondition them, and then they resell them. That reconditioning process has been a little bit slower than normal because of labor shortages and other challenges. So we think that's slowing down our unit growth, and that's been the primary driver of the stock price underperformance recently.
So what gets better, Seth? In other words, I mean, which of those sort of pain points starts to alleviate? Do they somehow find workers who are going to do those rehabs? You know, we know the pipeline of cars has also been slow. Is that going to alleviate? I guess we've seen some small signs of that with used car pricing starting to improve a little bit, but I don't know what other signs you're seeing out there.
Yeah, the demand environment is actually pretty healthy. So we think that's intact, at least through the spring selling season, which is the strongest season of the year. We're seeing dealers go to wholesale auction and other places to pay top dollar for inventory right now that they plan to recondition and sell through that spring selling season. So the question is, in our mind, can they get the inventory reconditioned quickly enough? And Carvana is working fast to solve that equation. They're hiring more staff. They're using third parties if necessary, and they're going to be able to grow unit sales sequentially as they add that capacity and that staffing to support the production of the vehicles. Another key piece of this story, however, goes beyond simply the unit sales in the near term, but to the profit equation. And that's the primary reason we upgraded shares of Carvana today. We see opportunity for them to improve the profitability of each unit they sell, both on the retail side as well as the financing that's attached to each vehicle they sell. So those drivers, because the market environment and because strong execution, should drive better than expected profitability for the company.
So talk me through how that's going to happen, because what I hear you saying is the auction demand is hot, which to me implies Carvana is going to be paying higher prices for their wholesale vehicles. And they're trying to hire a lot of people, probably, I would guess, at higher wages than they had been in order to get those people through the door. So those are two rising input costs. Are they raising prices a good amount to more than make up for that?
They are. Yeah, the prices are rising at retail. At the same time, they're rising at wholesale. And dealers who are most advantaged in this environment are sourced more of their vehicles that they sell directly from consumers as opposed to wholesale auctions. The reason is because the wholesale auction market is much more efficient than when you're buying it from consumers. And Carvana sources at least 65%, about 2/3 of the vehicles that they retail from consumers, which is a high amount and gives them an advantage from a profit standpoint, which will offset any of those incremental pressures that we just talked about from a labor cost standpoint, for example.
Seth, how concerned are you about the recent insider selling at the company?
Yeah, it's definitely been a point that has been raised among investors. We think that it's diversification more than anything else for the owners of the stock that have been selling. So we're not too concerned about it. We think that the outlook for Carvana is very solid, not just in the near term, but in the medium to long term. They are on a path to be the largest retailer of used cars in the country if they keep up this growth rate over the next few years, overtaking CarMax. They have a plan to do it, and we think that they'll be able to execute on that plan based on what we see right now.
Profitability has always been, an issue with Carvana. I mean, when are they sustainably profitable based on your modeling?
Based on our model, by 2023, we think they're sustainably profitable. And our analysis of their capital structure, their liquidity, suggests that they'll have little problem being able to reach that turn to positive cash flow and profitability in 2023 with the resources they have right now.
All right, we'll leave it there. Wedbush analyst Seth Basham with his call on Carvana today. That was our call of the day. Seth, thanks for hopping on.